Since topping out near 126,000 on October 6th, Bitcoin has shed about 40%, now trading around levels we haven't seen since March of 2025. That peak and the pullback that followed lined up with an all-time high in the Nasdaq, which has since slipped into a negative corrective phase. Now, a lot of analysts point to Bitcoin's correlation with the Nasdaq as proof that it's still a classic risk-on asset, but the picture isn't that simple. Something shifted in October that may be a clue. U.S. Treasury yields stopped falling. The 2-year yield has mostly moved sideways, while 10-year yields have climbed from about 4.0% to 4.3%. At the same time, the dollar has also firmed modestly. So the question is still on the table. Is Bitcoin primarily a risk asset or a hedge against dollar debasement? Now, the last few months have shown us a little bit of both. Now, we also have a new macro headline, the announcement of Kevin Warsh as the presumptive Fed chair. Markets have reacted only modestly so far, with Warsh viewed as not quite as dovish as some of the other candidates. And finally, there's a new government shutdown that could limit how much economic data we'll see over the next few weeks. In theory, uncertainty in Washington should be a tailwind for Bitcoin, but so far that has not materialized. If a trader believes that Bitcoin will recover from here, they could buy the February 13th Bitcoin Friday futures at 78,000 and target a move to the January 29th high of 90,000. Now, a stop for this trade could be placed below at 69,000. This trade can make $240 if the target is reached and risks $180 if you're stopped out of your level. Now, if a trader believes that Bitcoin will continue lower from here, they could sell the February 13th Bitcoin Friday futures at 78,000 and target a move to the 2024 consolidation area of 60,000. Now, a stop for this trade can be placed above at 86,000. This trade can make $360 if the target is reached and risks $160 if you're stopped out of your level.